My name is Raúl Carrillo, for those of you who I do not know, and I helped found the Modern Money Network, which is a student-based initiative, which is part of this whole dynamic we got here. I'm a lawyer by trade. I'm not a technologist. Indeed, Rowan Gray, who helped me found MMN, got there before I did, actually. He is the better amateur technologist by far. We work with tech people, and what I'm going to talk about today is really a lot of the structure of the financial technology sector, both private and public. I got here in a sort of weird way. I was in law school along with Rowan, many other people, at a time when FinTech started popping, right? It's not that old, 12 years old, give or take. Bitcoin came around. A lot of people were like, what is this? It's just an oddity. The law and finance professors we were working with were like, don't waste your time with that. Turns out that was a pretty good thing to study. In any case, it became part of the financial system as time moved along. In 2015, I went to the Consumer Financial Protection Bureau, and as a regulator, we initiated the first enforcement actions against fintech companies. That first one was a wallet called Dawala, and they violated various security laws in terms of how they kept data, et cetera. Since then, there's been some regulatory action in the fintech sector. It mostly takes the form of velvet gloves in the sense that you get to go play in that sandbox. You get a no action letter. You don't have to actually follow any of the rules because you're really innovative and neat, right? After that, I went to direct legal services, and I was, among other things, starting to help low-income New Yorkers deal with their apps, right? On their phone when you can't transfer money, whether that's through a banking app, whether that's through a brand new fintech app. People run into problems, and there's a real consumer protection interface that I've been focused on. Rowan, John, many of our colleagues, to put it crudely, are sort of working on design at a macro level. I live in the world of low finance. I live in the world of low tech. Out here where money is doing different types of things in different types of people's hands. After doing financial services, legal services in the finance space, I went to the Hill, where we were trying to stop the Facebook Libra, now Meta DM project. So working with congressional offices, administrative agencies, and since Biden was elected, the executive branch to form a strategy around crypto and fintech. We are, of course, the M&T Public Money Tech crew. We have a particular angle on it. We're just one of the voices here. And so what I'm going to try to do today is get you interested in all of this. I'll share my shit, and that's, I think it's important, whatever. But more importantly, what I'd like to do is outline a community research agenda where people can sort of plug in, maybe see themselves in MMT tech land, and we can go forward together. This is going to be a bit casual. I will stop for questions at various times. And that's important. I will call on people if I'm ready for questions. Otherwise, we will cover a lot of ground together in a conversation towards the end. So I hope that everyone is very present. But the exciting thing about today is that we're going to the future, right? And we're going to look at what money might look like tomorrow, the next day, the days after that, because all of this is going to change, right? And you're only as funky as your last cut. MMT cut its teeth by getting ahead, by predicting things, the global financial crisis, the Eurozone crash, having a particular view of the internet.com bubble. There's a lot to explore here. And for MMT to retain purchase, we need to have our eyes sort of on the stars, et cetera. There's a way in which you can become paranoid and stilted when analyzing technology. Hopefully we avoid that. I'm trying to hold back a little bit of the doom. When you get into this stuff and you see, that it's Silicon Valley is embedded in everything, et cetera, it's easy to go to a hopeless place. So we will end on an affirmative and reconstructive note before going on to conversation. Roughly speaking, I'll present sort of what I'm working on, my research agenda as an academic. After the Hill, I went to Yale Law School to help form a group, the LPE Project, which you've heard about, but also to study financial technology. My research agenda focuses on money as a technology itself, in addition to all these other, ways that we talk about money. And money is an information system. Money is involving data. Money is involving all these sorts of things. So The first part's going to be focused on my stuff, and then we're going to go to MMT, and we're going to talk about various ways, again, in which tech sort of changes our analyses or pushes us a little bit. Those developments matter, again, especially if we're concerned about seeing the future, if we're concerned about knowing the operational mechanics of finance, public and private. So what does it mean that money is a technology? So here I'll borrow a definition from a legal scholar from the internet Fdic movement, who is now into political economy, et cetera, Yochai Benkler. And Yochai Benkler says essentially that technology is practical and conceptual knowledge embedded in material culture. That's a lot. What that essentially means, it's not important. What it essentially means is that ideas are embedded in tools, in practical apparatus and infrastructure that we use every day. A material culture means that we've evolved practices around that technology, around the hardware, around the software, et cetera. The tech itself teaches us different ways to think about money, no matter what we carry in. We're all interacting with it. And in many ways, the future of money is going to be determined, sure, by the systems design and architecture, which is its own tech dimension, but perhaps even more importantly, the battle is going to be fought for public money right here, right? Crypto, FinTech, that has some appeal with younger generations. It's sexy, it's dark, it's whatever. Public money right now, for the most part, technologically speaking, is analog. It's old. Of course, you do interact with a private banking system wherein the government stands in the back. But in the FinTech world, that technology is known as legacy technology, or more crudely, dinosaur technology. And so what we have to do is move public money and the idea of public money into the digital space, into a place where it actually has purchase on people's head. It lives in our brains, it lives in our hands, et cetera. That war is extremely, extremely important. It's where Rowan and many of the rest of us have been working. And it's not to say that, again, understanding the macro dynamics is not important. It's completely critical. But I do think that you have to actually have a notion of how public money lives with people. Money breathes, money smells a certain way. People use money to learn certain things about each other. Perhaps most importantly for me, money is used to see things. Monetary instruments themselves collect various kinds of data. So real quick, just to situate us, because I know not everybody is up on all of this stuff. But it's good to sort of name names, et cetera. Somebody give me examples of fintechs. Raise your hand. Tell me an app on your phone. In the back. All right, you're cheating. Existing fintech. Kennedy. Venmo, thank you. Cash App, very important. Robinhood. What was this?
Apple Pay, Google.
Google and Apple Pay.
Visa, MasterCard.
Facebook. I'm sorry?
Visa, MasterCard.
That's an interesting one there. Okay, Venmo, Cash App, Robinhood, Google and Apple Pay. What's that? Coinbase. Yeah, I'm gonna try to work all these in.
MoneyGram.
So now's your chance to like get out there. MoneyGram. Interesting. I sort of see where you're going here, Jeff. PayPal. PayPal's the big one. Yeah, okay, that's enough now.
Running out of paper.
Right. Okay. So what all of these technologies do for the most part that everybody just listed is play with data, right? And in many ways, the evolution is on the tech side. All of our financial principles that we know from MMT, et cetera, still apply. That knowledge is extremely important. But the business model has changed. These are not banks. These are not legacy finance institutions. What they're trying to do is get more data to get more users, to get more data, to get more users, et cetera. So we are importing the Silicon Valley business model into finance. In some senses, that's more about coordination than it is about competition, but we'll get there. So the MMT elephant. I like this drawing. It was done by Neil Winston Smith, who is a post-Keynesian economist in the UK, I believe. And this just points to this problem that we all have, right? What is MMT? The guy at the top here is touching the elephant. Up there to him, it feels like a description of the monetary system. Here, some people are saying it's job guarantee, it's functional finance, it's sectoral balances, it's our banking things, it's chartalism, right? But what we're going to do is assess this, and I want you to keep this in mind as we move along. I will again talk about my stuff and we'll come and apply it, but that should be in the back of people's heads. And just remember, again, feeling the elephant, where you are positioned with respect to public money, with respect to private fintech matters, right? Your experience of what this is an important entry point. Nobody has a superior omniscient entry point, but it is important to understand that the lens matters, the way you're looking matters, the gaze matters, et cetera. And that's even more important when we talk about the tech. So we're eventually going to move on to a different elephant, right? And I don't know, I found this drawing on the internet. Why is it elephant 3? Because our enemies are already at Web 3. They skipped 2. So we're going to skip 2. 3 is bigger than 2. We've got a lot of work to do. All right. So everybody listed a bunch of fintech, right? But the truth is, all of these apps were created with, for the most part, in the last 10 years. PayPal's, older, but they all came around relatively recently. Money as a technology has a very long history. In many ways, we know that from the Chartalist research. People are literally bringing in these new practical tools to rope people into new systems. This is most obvious in the context of colonialization and goes back to what Forstater was talking about the other day. However, technology is everywhere. There's development that is brought in, that is conducted now under the NGO sector that involves money as tech. But everybody in the world who uses money is also using financial technology, almost inherently, right? We use hashtag FinTech now to talk to a particular group of products. But everywhere in the world, people have come up with different ways to, again, embed these ideas of how money is supposed to work into a particular material culture, into a particular infrastructure, et cetera. So there are many examples of indigenous money. Here we see the people of the Isle of Yap in the South Pacific using a particular monetary technology. Is it as nifty or agile as some of the fintech apps? No, but money has long been tech. And what we're talking about now is, again, this data play, right? And this is where my research comes in. Seeing through money. So again, what we're talking about is this sort of new thing where the information that money generates is changing qualitatively. But again, that itself is not an old practice. If you go to the anthropologist literature around data and around information, you'll see that taxation itself was often a technology to create new records. In England in the 13th century, when they start taxing people, that is the process by which surnames are created. That is a process by which people are organized. And so monetary technology is embedded in all of these systems to create records. The most obvious way in which data is produced by financial instruments is through the ledger, right? What is a ledger but creating data doubles of everybody? It is creating a new plane in which we see different kinds of social relations, but they're represented in a certain way by the technology. Ledgers are old. Ledgers are 6,000 years old, right? You got the priest in the temple, you got your book of virtues, you got your book of sins. Somebody stole something from the granary, somebody owes something to the granary, et cetera. Right? And we're used to working with centralized ledgers. This is the stuff of accounting. This is the stuff of banking. We represent things certain ways. People made choices back in Italy or whatever that now create this system. There were many other accounting systems, many other technologies, et cetera. And so often the issuer, the keeper of the books, right, has a sort of view of how finance works that is not available to people who don't have the ledger. In most cases, ledgers are centralized. Ledgers are kept by banks. Ledgers are kept by tax collectors. Of course, there's all kinds of private ledgers that are also centralized, at banks, et cetera. And if we talk about representing the whole world as balance sheets, as Minsky does, That's an information operation, right? We have to collect things, et cetera. And that's very important. Now, what we're seeing is a strong bent towards data maximization. And what that means, to put it crudely, is you try to get as much data as possible from commercial transactions, from public transactions, whatever it might be, because that way you have it. Even if you don't know what you're going to do with it yet, you throw the data stock in with all the other data stocks, the analysis becomes synthetic. You supposedly learn more about people, where in a way that's more neutral, more efficient, less biased, et cetera, often through the use of algorithmic technology, new algorithms, but not always. In many ways, capitalism is associated with data maximization. In the 1830s, we have the rise of the credit reporting companies, in part because there's no cash. The public or the federal government has minimal powers to issue public money at all. So we've got all these different kind of private monies circling around. But the credit scoring agencies essentially become the eyes of the business class in your books, and they collect information on everybody to report on your reputation, so that other people can see through the money. And in this case, with the credit scoring agencies, it starts where it's only applicable to white men in the United States of a certain class. In fact, the idea of a woman on a shopping spree spurs the industry during the 19th century, and then later on in the 50s in an extreme way. So it's gendered always. The labor force of the credit industry is, in fact, mostly women over time. And it's raced. You know, obviously certain people don't get to participate in the credit system because they themselves are represented as property, as assets, as liabilities on the balance sheet. That's what slavery was in a financial sense. It's a big part of it, at least. And of course, indigenous folks are swept into these account-based systems or trusts, and then all their money is eroded and they get to be watched forever, et cetera. But the play is that the credit companies centralize all this information and they make it available to the commercial sector. They hand it over to the government at will. I believe World War II was the first time that the US government paid for any of the information. In World War I, when Hoover was running around, the credit bureaus were just like, here you are. Here's all the information we have on everybody. So that's always sort of been a thing. In the 60s, once it becomes apparent that a few companies are taking over everything, the same that are around today, what we have is a push for inclusion, right? We have all the people who were previously left out of the system, among others, argue that they went in, right? Not out, like don't spy on me. They went in to be legible to the business class, to be legible to states, right? And that's how we get the Fair Credit Reporting Act, which was supposed to end discrimination, et cetera. They wanted things to be accurate. It was a very liberal vision of what all of this could look like. It didn't work. We'll get to there later. And so we have these sort of information plays. Now that dynamic that came out of the 60s and the 70s of wanting to be included has a particular life under neoliberalism. And we'll get there and talk about inclusion as a second. But what's really important here to understand is, again, the new technology tends to be data intensive. It tends to be done outside of banks. Just as there's this idea that we learned in MIT that there was once vanilla banking and, people only did so many things and they didn't play in the capital markets in the way that they do today. The separation of banking and commerce in the United States, at least, implied that banks could only collect certain data. And those are actually laws now. They're not supposed to go over certain bridges and they're not supposed to collect certain information, much less share that information with people, right? And so now what they do is they partner with all these other companies in order to collect the data. The FinTech companies in turn get to borrow the bank and not follow banking regulation. It's a lovely, lovely situation. Up here I have a graph that is from, I believe, a report by JP Morgan Chase that is called Payments Are Eating the World. And that is a riff off of Mark Andreessen's statement in the 90s, I believe, that software was eating the world. We're talking about a huge pot of data, right, in the digital money space. If social media says more or less what you like, payments get closer to saying what you do. Your credit and your debtor relationships get towards saying a lot. Once you combine those things, we're talking about a pretty, rich picture of who a person is. Of course, finance is just one piece of this. Anytime you're on the internet, you're being tracked. Essentially, there are tools to not do that, and we'll get there. But, or to try to push back against that. But finance occupies a particular place, I would argue, because this sort of payments data is so granular, because anytime you interact with the formal economy, you're going to be tracked. We've got a lot of different, we've got a lot of different products out there at this point. One thing that I think is really important, first of all, and I was talking with Kennedy about this the other day, is that a lot of this comes from video games. A lot of these ideas come from, places that we don't normally think about as money heads. And that includes the principles, that includes ideas about the tech itself. And so building virtual money worlds is its own whole thing. And on the other end, we have payments that are becoming embedded in the Internet of Things. And so somebody said Google Pay, Apple Pay, we have Fitbit Pay, right? Some people just swipe their wrists, for instance. Volkswagen and JP Morgan Chase have come up with, a car that you go through the drive-through, your credit card information is on that. It just like scans you, right? We're moving into a place where money is going to be everywhere. People talk about credit. I just think it's really important to consider the commonplace interactions that say things about us. So the legibility story again. Right now, what's happening, similar with, again, how things were happening in the 60s and 70s, is people are still pushing for financial inclusion. There are a lot of people who are not in the formal banking system, for better or worse. You look at the Fdic consumer banking surveys from the most recent one came out a few months ago, and you'll see, number one, people don't have bank accounts because people got no money. So let's not get confused about that. But number two is they don't trust banks, and number three is privacy, right? So people are out there sort of at the edges of the formal financial system. And in a way, the efforts of the 60s and 70s have not borne the fruit that liberal reformers thought they would. And so we have structural issues. The message from FinTech is that all you people who the banking system does not serve, right? So in many places, this is people of color, this is immigrants, these are people who have not developed a formal financial record. FinTech says, don't worry about the banks. We'll partner with them on the back end or whatever, but we got you. Crypto has an even more cynical message where it says, these communities have not built wealth. In some instances, these countries have not built wealth, et cetera. So what we're going to do is offer you an alternative system. And it really is sort of exemplary neoliberalism, right? Because these are a lot of obvious capitalists, right? But they're dressing things in the rhetoric of inclusion. It's that Silicon Valley gloss, right? Like, we solved the technical problem. We solved the technical problem of money. It's just math. Congratulations. Here you go. You're in the new system. All right. So this whole world, this whole world holds together in part because we have no privacy law in the United States. We have no substantive federal privacy law. We have no substantive data security law. There's a bunch of state laws that kind of suck. The GDPR in Europe is making strides towards more comprehensive privacy laws. So it's the general data protection regulations in the European Union. And they try to set some limits on data collection, which we'll collect at the end, or we'll discuss at the end. But that's also having problems with enforcement. There are issues, right? People are trying to figure out what privacy looks like, what it looks like to have some control over your own data, not necessarily to own it, but at least to manage it. And in this context, in this gap of substantive privacy law built for the internet, we have the FinTech companies show up, right? But the real actual hinge of all of this are the companies that have gone beyond the credit reporting agencies. Most importantly, Plaid. Plaid is connected to almost any FinTech app you're using on your phone. It holds the whole system together by serving as a hub to share data between fintechs and legacy financial institutions. The truth is, you're using your bank account. It's probably connected to 15 other financial services. It is connected to, on average, 15 other financial services companies. You may know of some of them, you may not, because we have, again, it doesn't matter as long as you've got the contract, as long as you've got the click wrap agreements, as long as the businesses have agreed to share data in a certain way. Extremely minimal safeguards. Plaid has become the pipe, essentially, right? The Plaid API takes data from the legacy financial institutions. It brings them into the tech world where it compiles and helps compile and compound this data. So you have all your apps in a super app, or you have all of your credit card information in one wallet, etc. Plaid helps build that. Plaid helps make this whole system possible. They partner with Amazon in terms of actual tech infrastructure. All the big people are sort of in the back, as you'd imagine. But that's just to say that it's important for all of us to know that they're coming, right? The business model works on data. There are no rules on data collection. They can take hits on the finance side that banks can't. For example, the Silicon Valley businesses, again, they are different. The financial institutions that are evolving are different. We'll get them on monetary principles, hopefully, but we are dealing with a fundamentally new kind of creature in some ways, and it's important for us to recognize that. The other thing that happens with seeing money, and this is the political scene again, this is the politics of financial technology that we have to deal with. So I'm going to go over here. I haven't seen you guys. Okay. So every time there's an information network, it's used to both do things that are constructive, right? It's used to ideally give people gateways into savings, into credit, into investment. And some of the apps do that for some people. But just as, there's the open hand, there's the closed fist. And that is always the case with these technologies. That's true for money in general, I would argue. You give people credit. Flip side of credit is debt. People like to talk about public lending. We don't really talk about public debt collection. There's always an other side, right, to all of these questions, and it's important to consider that. But these systems, these new systems, because they're so data intensive, for the most part, make things easier to track, right? And that's incredibly important. We'll talk about crypto in just a second. But so 3 examples that I talk about in my research of public-private financial technology gone wrong: Ebt cards, release cards, transit cards. All public money, you'd argue, that has been farmed out a little bit. Let's start with the most obvious example. So that's release cards. When you leave a carceral institution, you are given what used to be called gate money, right? So that can include the money that you brought in, and also the money that you may have received from family members or otherwise gained in the inside that is held in a trust account. The market for financial services within prisons, both inside and outside, so in the carceral institutions themselves, and then on the outside in the context of parole and probation, is JPay, right? JPay dominates this market at the federal level. There are a few other companies like Numi Financial, for instance, that provide release cards to ICE and work with other players, but JPay is the big one. So what it means to have this card as the gate money instead of, for instance, cash, which it was a long time ago, when JFK established the regulations for the Federal Bureau of Prisons in the 60s, gate money was like 25 cents in a bologna sandwich. It was very analog, right? And what we have now is these cards that are supposed to help people reenter society, are supposed to help with digital inclusion. And in some senses they might, but the problem is there's all these fees, right, that erode the value of this card often by the time that you've used it for 1 or 2 transactions, right? And there are very minimal rules on that. But, and it also, and this is the dangerous part, has the potential to extend parole, for instance, by technological fiat. When you use cash, the law enforcement can't see what you're doing, right? You use this card, law enforcement can see what you're doing. And we may have different thoughts about this, but the point is, again, is the data play, is this idea that people are being included, is this idea that public money or money serving a public function should eventually take this kind of form. If you want to learn more about this, the CFPB recently sued JPay for unfair, deceptive, and abusive behavior. And then there was a lawsuit in Oregon wherein people who were swept up in a Black Lives Matter protest were given release cards. Again, no choice. And so essentially it winds up to spending a night in jail and then losing all your money, which is not precisely how that should go. Transit. So transit is important in many respects because it's evolving extremely quickly. Less so in the United States than in Japan, less so than in China and in many other places. We all have to use the transit system in an urban society, right? And the idea, again here, is that you can make things faster. You can instantiate, fare reduction or fee reduction, like on the spot through somebody's app. The Omni system in New York is sort of the evolution of a lot of the transit technology. It actually is relatively cutting edge. It's built by a company called Fdic, which also built Oyster in London, which also built the Octopus Card in Hong Kong, et cetera, et cetera. And Fdic has decided that all this data should live on a cloud. Does it have to do that to achieve its functions? No. Or it doesn't have to do that to achieve basic transit functions. The old Oyster card in London was dumb. It was a stored value card. The information is stored on the card itself. It didn't upload information into the cloud like this does. Fdic and the MTA will say that this is, again, a faster system. It allows us to be more inclusive, et cetera. But open hand, closed fist, right? This data also goes to the NYPD, who are notoriously not shy about using transit data to catch people in poor communities of color for the most part for fare evasion and that sort of thing. There are substantively no rules on that data sharing either. And in fact, that's a transparency problem. That's a site problem because the New York City government is not interested in creating rules around this sweet, sweet contract that they have. So another one, and this is, I think, demonstrates the problem in a little bit more of a nuanced way, is the Ebt card. So for a long time in the United States, as well as in Europe, welfare was in kind, right? You get a box of things, food, etc. That idea sort of went away when the question became, and this was a fight among social workers and theorists and people on welfare themselves, what is the constitution of public money? Again, what does the technology look like? Why can't we allow these people to participate in the market? And there was a whole conversation about giving people cash versus giving people things. This is extremely important. In the 80s, this whole rich conversation is run over by a bulldozer that is welfare reform. The technology, the key technology of welfare reform and the digital poorhouse that people now live in is the Ebt card. That was a neoliberal idea, even if we now prefer it to cash for other obvious reasons because it is more inclusive. But again, the idea was that people would gain access to things, but they'd be more easily punishable and more easily catchable when it comes to fraud. Today, SNAP fraud, for instance, is like fewer than 1% of all transactions, but there is no bottom to a governor in a red state wanting to collect as much information as possible from someone who's on welfare. In this instance of this technology being manipulated in 2014, Governor LePage of Maine just released data on everybody who was receiving public assistance, but had been to a casino, had been to a restaurant with a hot meal, et cetera, to try to expose violations. Now, with the pandemic, people may have died without the Ebt cards in its online version, right? We had to get people food, people had to eat. And so we faced this real choice of, expanding this digital system to get people what they needed or, letting people suffer. And more importantly, there was also a choice as to how this technology would work. Did it need to involve Fresh Direct? Did it need to involve deals with Walmart? Did it need to involve all of these things? And we can have debates about this. The point I want to make here is that this whole narrative of fintech, inclusion, integrity, open palm, open fist, or excuse me, open palm, closed fist. That's what really matters here, and to keep in mind in the tech, again, because how public money actually lives in the world is going to matter in terms of promoting our ideas, but also in terms of mechanically understanding the next system. These pandemic cards were a big opportunity for us to figure things out. And they, Rowan took the lead on legislation, the ABC Act, with Congresswoman Tlaib and other folks that would have sent people cards that were a lot more private than what they received, or given people at least a choice. Do they want a card that's data intensive? Do they just want to participate in society? We'll get to eCash later. So just like there is a consumer reporting structure, Experian, Equifax, TransUnion, which compounds data, collects data from all over the economy, and with all of the security risks that entails, as we saw with Experian, losing 150 million people's social security numbers, et cetera, we have an analog on the criminal side. This is the world of the Financial Crimes Enforcement Network. This is the world of the IRS. This is the world of every little institution that serves a disciplinary function within the broader financial system. So this world exists because of the Patriot Act. Arguably, it all started in the 70s. We get money laundering rules. People say it's about Swiss banks and the way in which people were evading taxes. I think that's true. Although on tax evasion today, the call is coming from inside the house. It's fun to go back and read the MMT takes on the Panama Papers, Pavlina's, for instance. But right, it's also anti-money laundering law, which was the first law of its kind in the world, starts during the war on crime. It starts during the war on drugs. This is about rounding certain people up, right? Carrying bulk cash is criminalized in a way that it wasn't before. Going after people becomes really important to regulators in ways that it was not before. And again, that's not to say that money wasn't an information system before the 70s, much less before now. But the idea was that they were going to put cops inside of the system itself. Thurgood Marshall, on the Supreme Court in the case called Miller versus United States, 1976, foundational privacy case, says, I don't think the government gets to look into your bank account without the Fourth Amendment, because I know exactly who that is going to affect. Because of the inequity of government and regulation and policing in general, we're not going to get the big boys. What we are is going to have is a bunch of ticky-tacky, and that's correct. El Chapo smuggles money through the HSBC system. Hong Kong Shanghai Banking Corporation receives a deferred prosecution agreement from the United States Department of Justice. No international justice, really, because they're big. And as Lanny Brewer at the Department of Justice says, they are literally too big to the economy. We can't let them tank. This goes out the window, right? Who does get in this situation is your abuelita who's sending remittances back home, right? Because that transaction looks suspicious. The Patriot Act literally deputizes financial institutions as force multipliers, as it does in so many other contexts, to surveil people. The average teller at the bank, Western Union, perhaps more importantly, MoneyGram, that person is required to flag any sort of activity that they deem suspicious. And that's in the eye of the beholder, right? I used to have clients and they are suspected to be Haitian in a Guyanese neighborhood or whatever. And it's like, I don't like you. That looks suspicious to me. So that person can't send money internationally because there's no actual public system. It's a situation in which, again, the government is relying on the private sector to collect information, but also to block transactions, to report, et cetera. At this point, a lot of this information that's required to be collected under the Patriot Act is centralized, yes, with the Financial Crimes Enforcement Network, but perhaps even more importantly with its private partners, Palantir, Plaid, et cetera, right? So a bunch of the Silicon Valley companies are on both sides of the consumer reporting and criminal reporting system. The other thing that's really happening in this space, and I held off on talking about it because it's sort of its own thing in some instances, is crypto, right? So crypto has a little bit of a different attitude towards data than other sort of fintech enterprises did or have had. Crypto is created with a particular model of technology and society and money in mind. In the early 1990s, in the days of the internet freedom movements, there were cypherpunks, people who wanted to build a a monetary system beyond the purview of the banks, which had just failed, beyond the sight of the government, which was clearly using the Patriot Act to spy on people within the formal financial system. The thought, and it's libertarian, anarchish, with Bitcoin, was we will literally build a new world. And the way that they're going to do that, based on the monetary model, and lots of us have written about this, Eric Tamoyne, I think, was one of the first people to write about this, is just to really replicate digital gold. We are really talking about people with significant computer power, miners, solving complex Sudoku puzzles to emit coins into the world, right? There's supposedly a hard cap. It's built on a model of artificial scarcity. It's extremely volatile. There's no taxation circuit for all the reasons that we support fiat currency from a structural analysis perspective. That's all the reasons we don't support Bitcoin, right? But Bitcoin is also a data play, right? The idea is that the transactions are encrypted so people can't read them, so you've made a private system. That's not exactly how it works in practice. So we talked about centralized ledgers and the idea that, you know, everybody's recording everything, and that's in part the idea of the money itself, right? Let's go back to Yap. So on the island of Yap, people have been there for thousands of years using essentially giant boulders as money, right? What does that mean? Right? You can't carry that in your pocket. What kind of fintech is that? But what's important here is the information, right? What's important here is how things are recorded, so to speak. And on the island of Yap, you obviously can't move these stones very easily. So they develop a ledger between themselves. They tell a collective story. Everybody has a copy of the story in their mind, right? And the idea is that if you deviate from that, you will be ostracized, you will be punished. And so collectively, we are going to keep a decentralized ledger of what is going on in our community. That is the data principle of the blockchain, which is Bitcoin's payment system. Joseph Sommer at the Federal Reserve, a banking lawyer, likes to say, money is what payment systems do. Payment system is in many ways a communications network. It yields information in a particular kind of way so we can live in society, right? But the idea here in Yap was that this is a village, this is a community, right? When the distributed ledger technology is instantiated with all this insane computing power to create Bitcoin, their idea is building trust among strangers, right? That's sort of a different enterprise. Scott Ferguson's presentation at the MMT conference a few months ago, the Modern Money Network conference, had me thinking a lot about this sort of dichotomy where people who are very interested in crypto and want to hide and want to be outside this system have adopted this private model that is seeking sort of a hard money feel, right? It's like Bitcoin's on the internet, but we know it's sort of modeled on gold. You can take it into cold storage, you can put it on a hard drive, et cetera. And then the blockchain is this idea that you can still have a trusted community, even with all this. And it's more of a democratic ethos. And I don't want to get on crypto too much. There are people in the MMT community who believe in blockchain as a democratic tool. I'm waiting for extant proof about that still after all these years. But people do have this idea that Ethereum-based systems could be used for public money, et cetera, et cetera. But that's not what's happening, right? So we have Bitcoin, it crashes and burns for monetary reasons. It turns out that it's not as private as people think it is, but it has problems. And then so we get to crypto 2.0. the basis of which is Ethereum. Ethereum is not necessarily built for money. It didn't have money in mind in the same way that Satoshi Nakamoto had money in mind during the creation of Bitcoin. Instead, Ethereum essentially, if Bitcoin approaches money as gold, to put it crudely, Ethereum approaches money as Legos, right? We're going to give you this platform, and upon this platform, you math whizzes can go ham. Like, you can figure out whatever you want to do. And, we as a community will figure out what money looks like. Ethereum is used, again, as a platform, but the people who make an Ethereum network work, again, have all this power, right? We talk about blockchain being decentralized. We talk about blockchain being democratic, but the truth is the people who've collected all that gold get all the powers that you think you'd get when you collect all that gold. And in the case of Ethereum, it's the people who actually run the books. It's the people who actually run the systems. The Ethereum Foundation will come in and say, this is the real copy. That is a fake copy. Or it hasn't quite gotten there yet, but that's on the horizon. In general, cryptocurrencies built in Ethereum can serve a variety of functions, but this is a better platform in the crypto community's mind upon which to build credit products, upon which to build investment, upon which to build all these other kinds of things that we see. But in Ethereum-based projects tend to take privacy a little less seriously. Ethereum is the choice platform for DeFi, all this other that we've seen recently. And DeFi means decentralized finance, even though it's quite not decentralized. So people will say blockchain is anonymous, or they'll say it's immutable, they'll say it's decentralized. Both of these things are not true. Also, it's really not anonymous. Again, Silicon Valley has its own idea of why it wants to use this system. And the reason that it's not anonymous, as people say, not as anonymous as people say, is again, because you're sharing a copy of the ledger with everyone. And so that has security benefits in the sense that you can check people theoretically, but it also means if someone breaks through of one of the nodes in the nodal infrastructure, then they can work backwards and trace things, right? Most people pay for crypto with bank deposit money out of a digital wallet that lives on their phone, which is accessible to all kinds of people. Some of the wallets are more private than others, but that information is being compiled in law enforcement. Back to the criminal reports. Law enforcement has gotten a hold of this. The Financial Crimes Enforcement Network now has a revolving door, essentially, with a company called Chainalysis, which tracks all these payments. So this is more or less the world that we live in now in terms of FinTech. I think I've got 36 more minutes. So we're going to go to MMT. I just want to pause for really clarifying questions. Like, if you want to bring something up for discussion, don't bring it up now. But if you want to clarify a concept. Chainalysis. That's chain, ALYSIS. Yeah. Yeah. It's not one of the better names. Yes.
Can you explain a bit more what are the Ebt cards? I remember.
Oh, yes. Yeah. Yeah, sorry about that. So electronic benefits cards, are sent to people who are on public assistance in the United States, and I believe in many other countries, to help purchase food specifically, but they can be used for all kinds of other things in terms of a benefits program. And the idea is just to allow people to participate in the economy as if they had a private credit card that was issued by a bank and not necessarily in partnership with the government. And the idea was that even this would reduce some shame, right? If you're in a checkout line, that you use the same instrument as anybody else. You don't use a paper food stamp anymore, for instance, which demarcates you as somebody who is using a different kind of money, who's in a different kind of system, et cetera. Of course, again, when these red state governors, the conservatives create these cards, they're neon orange and they're neon yellow, so that, people are shamed, and now people buy covers to like hide what that actually is. One of the problems with that system. Yes.
You know who pays for all the computers that do all the mining and everything? Like who?
Individuals. pay for that, which makes it a not accessible system because it's very difficult to become a miner, right? Of course, there are corporations and consortiums and mining pools that now exist. Texas has just passed a law to really or is about to pass a law to try to bring all the miners over there in a more corporatized structure. But the idea has been that anyone can jump in and be a miner given sufficient computing power.
Yeah, you're saying how these tech companies are just like funding the old institutions like that, or a lot of most of the funding to the regulation of financial.
Yes, the regs, but the business model is different because the fintech companies, sure, they want the money from fees, but they want the data fundamentally. And that's different from a legacy bank, which is supposed to be boring and you're supposed to trust it and they're supposed to keep things private, blah, blah, blah. Yes. Sorry, there are benefits to paying in cash? Or?
About their benefit for accessibility but not being in cash.
Yes, certainly. So when you pay for something with cash, you don't create that record, right? That doesn't Ebt Card come with your credit report. That doesn't, the Zelle doesn't see it in the bank, right? It doesn't take that into account when it's assessing you as somebody who is deserving of services, et cetera. So it's difficult to build a formal financial life just based on cash. No, not at all. People very much want to use cash for particular types of things. And this is an important point when we talk about technology. You know, on my phone, I've got not fintech apps, but I do, except for like Venmo, et cetera. But I have cash, I have credit cards, I have a variety of transit cards. We all use different payment methods. And the truth is that people who use cash is cast as dirty, as poor, as for particular kinds of people. Almost everyone uses cash in some respect. And so when we talk about cash as a form of public money, we're really talking about a certain kind of universalism, which we'll get to in the end. All right, let's do some MMT. Going back to the elephant. All right. Actually, let's go back to the analog elephant real quick, just to remind ourselves what it is. Okay, we've talked a little bit about describing the monetary system and categorization and information and surveillance. So that's done. We did this guy. Then we're going to go back to chartalism. Then we're going to go to functional finance and sectoral balances, which is where I need help. Then we're going to do banking at the trunk. And then we're going to do job guarantee, and then we're going to tie it all together. Okay. Neo-chartalism or neo-chartalism, right? What is happening right now? What is going to happen in the future? Companies, again, everybody's into credit, everybody's into investment data, et cetera. But I do really think that the battle for the future is at the currency level. That was the reason that we were so afraid of Facebook TM, right? Sure, they may establish a tool that people use to participate and engage in all these tech worlds that we live in and all these internet worlds that we live in. But the scary thing, the truly scary thing, was that Facebook, with the promise of technology, was going to lead a Silicon Valley consortium, including Uber, PayPal, all the usual suspects, but also Coinbase, a lot of crypto folks, and then the development NGO sector, Kiva, Mercy Corps, Women's World Banking, all of those companies under the banner of inclusion. And it was going to take their new corporate currency, which is issued from a blockchain, which is based in Switzerland, et cetera, et cetera. And they're going to take it into developing countries, right? And that is essentially going to replace a local currency because of how easy it is to use, because Facebook is bringing this infrastructure, because it'll offer you free basics, basic tech package, but now it has this money thing in it, et cetera, right? That doing that, no one's really done that yet, but it is sort of happening in the crypto world when we see, for instance, Bitcoin build on dollarization in El Salvador, right? That is an instance where the imperialism has sort of already happened, but now we have a corporation coming in and achieving functional monetary sovereignty in some respects. It is serving public functions. It is creating the first digital IDs in some countries. It is a whole new form of imperialism through FinTech. And when they get in on the currency sector, things really become problematic for all the MMT reasons that we know, right? It is one thing for MetaDM, it's one thing for Meta to have WhatsApp Pay out there and to be using Facebook Messenger for payments, to be creating Facebook credits, et cetera. But to actually have your own currency, in this, I focus on a lot of this when Rowan and I and Tamara Nopper presented at the third International MMT conference. That is an awesome power, right? That's when you can pool things. That's when you can establish a payment system. Then you establish credit denominated in that money. Then you go into investment. Then you go into capital markets. There's that whole world, right? Facebook failed. I'd like to think we had something to do with it. In reality, they were sort of around and they didn't know what they were doing. And it was a bad marketing strategy, et cetera. But those folks are coming. Amazon, Apple, Alphabet, also involved in all of this stuff too. They're being a little bit coy. But the tech companies are interested in building their own worlds, right? And so MMT is going to have to grapple with monetary sovereignty. Various people at this conference are interrogating what it means from the perspective of different countries. Should we even be using sovereignty as a frame when we want to consider international coordination, et cetera? Now we have to think about corporations in there. It's too real. Right? Now we have to consider the possibility that they are going to vie for monetary sovereignty around the world. And again, DM collapsed. It's just beginning. What does that mean? What does all of this mean for functional finance? And here we really get into Rowan's research. So Rowan, you're welcome to say a couple of things about it if you like. MMT, again, got a lot of attention for understanding the mechanics, for having an understanding of how the back of the house works, how budget processes work, et cetera. Understanding the operations, understanding transmission mechanisms, kind of approaching all of this a little bit like tech people, right? What is happening now, and that G just stands for government, is that governments are creating digital fiat currency. In the United States, a digital dollar. We've got the digital, the digital yuan, et cetera. Almost everybody is trying to move forward in some way, some faster than others. What digital fiat currency means, and this is important for the MMT dynamics, both on the public design side and the private regulation side, is that governments will soon be able to send money directly from government computers to individuals, households, and firms. And what that means is it bypasses the commercial banking system entirely, or has the potential to do that, to offer everyone a Fed account, to offer everyone a postal bank account, to offer everyone blah, 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 blah on the consumer end. But in the back of the house, things are going to change. Jerome Powell at the Fed does not share a democratic vision of what digital public money should look like. In fact, what he wants to do with this opportunity, I think if you read the cards and the statements and what he's saying and who he's seeing around Washington, D.C., et cetera, is let Silicon Valley into the back of the house. Sure, they're going to streamline all kinds of monetary operations. They're going to try to make things easier within the parameters of the law, but if we get legislation, that can all be rearranged. And we can talk about Silicon Valley corporations having master accounts. We can talk about what STABS, Stephanie's acronym, actually looks like once they rearrange things. This is all going to change. The nature of public finance is going to change with the tech. Rowan, do you want to say a couple words on that? It was a bit weak.
Only that I got into this stuff through the platinum coin thing, which itself was almost a technical hack, right? Finding the one monetary technology they haven't closed the door on and using that as a budget sort of wedge to talk about a different way of dealing with debt ceiling crises, which was the legal kind of technological door closing on the way that we know budget policy should look. And so thinking about coins there and thinking about what the coins represented, and obviously we're in a digital world, But when we talk about the trillion dollar coin, one of the great things about it was that it broke people's brains. Because as I said before, when you have a coin the size of a regular quarter that's worth $1 trillion, on one hand it's physical, all right? It's not just abstract where you can keep it in the realm of something you don't have to think about. The numbers are too big on the balance sheet to be real. It's real because you're putting it in your pocket. But it's so big that it doesn't fit anything that people understand. And that was an interesting way to think about the digital technology on the other side.
Great. Excellent. Thank you, Rowan. So that's again really important. That doesn't hit all the macro points, and people should feel free to come in here. But I'm just here to say that what is functional finance is about to change, right? Again, not in terms of the macro dynamics, like those don't disappear, but how this process works in various countries is going to be different. It's going to be completely different in 20 years from now. All right, now we get to the big one, shadow banking. So crypto just crashed, right? Why did it crash? In large part due to all the failures in establishing a monetary system that MMTers are so familiar with, that post-Keynesians are so familiar with, etc. So what is happening is reminiscent of GFC dynamics in certain ways and not in other ways. So the main problem that we have right now is one that Randy identified as the core of what happened with the GFC in 2013 in a law review article, in a UMKC law review article. He said that we have a flush of non-deposit deposits or deposit-like obligations. All these crypto balances, or many of these crypto balances, especially with stable coins, are essentially held in wallets with the nominal promise that they're as good as the dollar in your pocket, or as good as the euro in your pocket, or whatever it might happen to be, right? But they're not. They don't have FDIC insurance. They don't have all of the regulations that we associate with a bank account. We see people get wiped out recently precisely because crypto didn't want to live in that world. The stable coins, are backed up in some cases by algorithmic processes, and just back to the idea of money as Legos. Some of them are backed up by funds, and they're essentially investment companies, but they have not wanted any kind of regulation. And so crypto built an entire ecosystem with these non-deposit deposit stable coins as the guts, as the main ingredients of what was going on. So you have a million different crypto coins, right? And people have come up with all kinds of, but stable coins became the base layer. They became most of the assets or most of the liabilities on balance sheets, right? They became collateral in trades. They became a benchmark asset. So what happened first, and this was a few weeks ago, was a coin called Luna, which is issued by Terra, failed. Algorithmic stablecoin, everybody knew it was trash. It finally happened. But what you start to see is the contagion from the shadow banking structure ripple throughout the rest of the crypto industry. Next, Tether fails, largest stablecoin. That's the one that's the key ingredient really for the crypto industry. Tether has been in litigation for years about misrepresenting things on its balance sheet, about reporting incorrect information. And it has been difficult for government authorities to actually determine what is going on over there. So Tether crashed, which meant that the crypto market had to crash. It's still not over. Obviously, there are ripples every few days that folks have been here. Celsius, another one, really crashed. Now we're at the point where venture capital firms are crashing. We are at the point where Coinbase is having to, do all these things that it said it would never do. We're at a point where the crypto infrastructure is rupturing. The crypto politics are also rupturing. There are some diehard people who will never, ever ask for permission for the government to do anything because it's all about this anarchist stuff. It's all about this anarcho-capitalist stuff, right? And they don't want to move an inch. If they're going to move an inch, they want light regulation, right? They want money transmitter licenses at the state level that didn't stop MoneyGram or RIA or Western Union from falling in the last crisis and are not particularly helpful in general. They want a special charter from the Office of the Comptroller of the Currency to officially do banking stuff without being banking regulated or regulated by banking regulators. The most important thing, though, is that those people are a small number, right? And what we're seeing is people try to figure out now, like, okay, what kind of federal regulation should we have? The most important player in this world is Sam Bankman-Fried, who runs FTX, which is essentially a crypto derivatives company. And what he's doing is donating to Democrats, and his partner is donating to Republicans across the board to try to build a political network that supports crypto within a particular vision of compliance. And for Sam, that means being regulated by derivatives regulators, and don't bring banking regulation anywhere near me. Despite the fact that other people have gone even further, one of the main people from the Ethereum Foundation asked after the crash, why don't stablecoins have FDIC insurance? As if that weren't the conversation we've been having in Washington for the last year. This is important, and I hope that's helpful in understanding what's going on with crypto. But in many ways, this is a dress rehearsal for what's going to happen with the rest of FinTech. Stablecoins are important. PayPal also keeps your balances. Venmo also keeps your balances unprotected in your wallet. You have some basic consumer protections, but there's no FDIC insurance. In some cases, you have what's called pass-through insurance, where the fintech company will tell you that the top deposits are protected because it's commingled them into its own balance sheet and it's put them in a bank. That does not mean that you are protected. That means there's a party in between you two, and your redemption rights, to the extent that they exist at all, are with the company. They're about the company. And you are protected, perhaps in the instance of a bank failure. You're not protected in the case that PayPal fails, right? You're not protected in the case that Venmo fails. And PayPal as a company is now the size of a mid-tier bank, right? It's like a PNC in terms of the deposits that it has on the books. The problem, though, is that it's also an e-commerce company, one of the biggest in the world, right? Again, they've been able to coordinate to cross the lines between banking and commerce and to play around without rules. Again, Silicon Valley is winning the political fight. So while this system is not, the fintech systems are nowhere as near as big as the mortgage lending systems, et cetera, or the MMF structure that existed before the crisis, it's growing so quickly that, again, it's coming down the road. And we have to be ready for the future. This is a shadow banking problem in the tech sector. I am not capable of doing the broader analysis as to who's investing in all these companies, but also data brokers. What happens if a data broker goes under? What happens if Plaid goes under? This is the work of economists that we, I think, desperately need, even though lawyers or progressive lawyers and critical lawyers and heterodox economists have been allied around our thoughts around how shadow banking works for a long time. So when we talk again, we go back to the elephant and we talk about endogenous money being a core part of the MMT thought. That lives in the tech world now. That is happening. And, they're not licensed banks, but if you follow the Minsky aphorism, if they get the money accepted, that's a big deal. If they partner with states and governments, especially in the global South, to have tax enforcement, for instance, be able to pay your taxes in DM, et cetera, we're talking about functional sovereignty. We're talking about extreme political power. Okay. Very quickly, because we're getting to the end, I want to just really talk about a bit what this means for our broader strategy, and the job guarantee serves a particular place in our macro vision, et cetera. And I'll only say here that as we move along, the gig economy is the natural enemy of the job guarantee. A lot of people have started working on that. Derek talks about that. Rowan talks about that. Sanjukta Paul talks about that. But this sort of idea that you have at-will employment that is scattered and you have no organizational rights and you are treated as an independent contractor when you shouldn't. Obviously, the job guarantee is offering an alternative to that model of work, right? It is saying something out there. But the job guarantee has to have jobs where people interact with tech. There has to be some aesthetic to it that appeals to people. The surveillance conditions of workers matter quite a bit. And when we talk about tech infiltrating the workspace, I mean, people have done so much good work on companies like Uber, for instance, which are also offering payday loans to their drivers, which are also embedding payment functions inside of cars, et cetera, et cetera. So when we talk about work, it's not divorced from all of this fintech either. And so we have to have a vision of how it interacts in the job guarantee. Not the subject of the presentation today, but I just wanted to put that out there. What do we do? One idea is, I think, on the data side, to try to instantiate a bit of what is in the GDPR, which is to say, flip the baseline of data collection. Right now, all that is not banned is permissible, which is to say most anything is permissible. And the GDPR tried to instantiate what is called purpose-based regulation. You can only use this data for the thing that someone consented to using the data for. Then you get into fights about consent, though. What does that actually mean? If you move on beyond consent, you go to intentionality. Then you sort of come up with all, right, to try to constrain private fintech data collection and thus the business model of these companies that are threatening the broader macro and legal structure that we live in, right? And this cartoon sort of illustrates the problem here, or the legal doctrinal problem. So design or regulation is hard. This book is one of the hardest books I've ever read in my life, but it goes into a theory of informational capitalism. So if Minsky talks about us living in financial capitalism, again, the business models are changing. We're going into the data world. We have to think about these things just a bit differently. The other thing, and this is the vision of hope a little bit, is that we have to build this public fintech system, right? The digital dollar system is coming. Digital fiat currency systems are coming in other places. Rowan and I and others support a wide variety of public fintech instruments, including bank accounts for everybody. But as we've discussed, a bank account comes with advantages and disadvantages. You build your formal financial life with a bank account. Right now, bank accounts, because of Zelle, because of Plaid, because of et cetera, are not particularly safe. They're becoming more data intensive. Is the federal government in the United States going to follow that model? Are central banks in other countries going to follow that model? Seems like it. Powell's more into data maximization and, again, bringing Silicon Valley private partners into the monetary production process itself. So, I mean, this has been around a lot, but Rowan and I have decided that we and our comrades and our allies on the Hill are going to intervene at the technological design level. The best way to preserve a space for privacy and a more secure space that's not vulnerable to something like an Experian hack is to keep the data offline, right? We are uploading cash into the 21st century. And the idea is that the money itself is stored on hardware rather than software. It's not even out there. We're offline instead of online. Perhaps there's a SIM card on your phone that you use for the money. Perhaps there's a card. You know, I prefer the card for various reasons. You tap it, it's just like a card that you, a bank credit card that you might use now, similar to transit cards, but it offers a place for us to just be people within the financial system, right? It would be mostly limited, as cash is now, to commonplace peer-to-peer functions, retailer functions. We do envision a place for it for remittances and for sending money long distance. What that actually looks like is an ongoing process, and what the law looks like around that is something we will probably have to craft. Right now, I would say that the important thing to understand is that eCash is being designed and envisioned by us and Congressmember Lynch, who is the head of the House Financial Technology Task Force. We do envision it as, as an entirely new thing, and as something that we would all use in our day-to-day lives. So that is the vision, again, to have that as well as Fed accounts, to have it treated, and sorry, this is where I was going earlier, treated by the law in many of the ways that paper cash is now. Of course, there are going to be new issues we have to address, But we envision really a pluralistic monetary system that preserves many of these technologies that we have been using for thousands of years and doesn't just lose them in this web of a panoptic and synoptic public money system that is just down the road if we don't do anything about it. Maybe you believe in cash or not, but the point here is that digital public money is going to have a form. Again, we are going to touch it. We are going to breathe it through our lives. We are going to have a relationship with public money that is very sort of more intimate and personal. And we need to figure out what that actually looks like. This, by the way, this graph was created by I believe, John Kiff, formerly of the IMF. Is that right, Ro? And I have my quibbles with it, but it's sort of helpful in understanding this is yours. Well, we'll talk. Yeah. But hopefully that graph is helpful in comparing not only use cases, but the tech. Okay. That is the presentation. We have like 10 minutes for questions. No, don't clap. It's not over yet. All right. I say don't clap. All right. Yes, please.
Need the mic?
I don't know.
Okay.
Sam? Okay.
My son got into trading Bitcoin,
Uh-huh.
and it seemed to me that he was always trading them for fiat dollars.
Yeah.
And when I saw that up here, cryptocurrency has its own unit of account. I guess that's sort of true, but the value of the Bitcoins that he was trading and other ones that I've seen are all measured in the fiat currency of the day. So I'm a little confused about that.
That's a really important point, right? And because people don't want to stay in Bitcoin for the most part, most users, and they have 0.01% of a Bitcoin, it is measured in dollars, and we do talk about it in dollars. And this also brings up a sort of nit in the theory of Bitcoin. And we've people discuss this in the MNT community all the time, but is it a payment tool? Is it a currency? Is it an investment asset? It seems like an investment asset if you're denominating it in dollars, right? So Bitcoin is sort of its own thing, but these new sort of cryptocurrencies, these new digital asset systems are sort of openly more tethered to the public systems. So that's a very important point. Thank you for raising it. Jeff.
Can you talk about how the real world has a justice system and cryptocurrencies don't? Meaning the real world, you can give justice to crimes, you can undo mistakes. And in the blockchain world, that's not possible. And I'm wondering if there's any other kind of profound differences like that between the real world and cryptocurrency.
This is very good. I would resist the temptation to say that crypto is not the real world. I think your even more powerful point to like bring that out is that this is a different system of governance, right? Different system of justice or not justice. And the idea with Bitcoin was to distribute that. So it's like the wild, wild west, right? With Ethereum, we do see more powerful players, and there are many of the same names you're used to, exercising a certain kind of control. But this is borrowing the functions of the state. It is serving public governance functions within a system, and it's very hard to check people. So the fear within the DM system, for instance, even though it was reportedly decentralized and including like 15 different companies from Silicon Valley, was that the corporate bylaws suggested that Facebook could do essentially whatever it wants with respect to retention rights, with respect to changes in the blockchain, if it needed to, et cetera. So I think this point is critical, Jeff, and I thank you for raising it, because when you build those private monetary systems, the rules are going to be what the rule makers say. Of course, that's what a state is, but ideally we can at least have a chance of some democratic pressure there. Andreessen Horowitz does not care about justice on the blockchain. And that's one of the venture capital firms that funds all of this. So Jeff, your point is, I think, mission critical. Kennedy.
So here's what you think about the role and importance, especially when designing this system and getting involved with other countries, but especially with that, what do you think the role that messaging should play when it comes to social things that we can do with money that haven't been decided yet, like when they're still working out, i.e. drugs, sex work, women's rights, civil rights? Where do you think the average might the focus of that, which is the arguments that we get to?
Yeah, absolutely. So if we build a surveillance system, it's particular people who are going to suffer, right? Everybody uses cash, but cash is particularly important in informal economies. It's important for people who are just trying to get by, but might be on the wrong side of the law. And then we can have debate about whether those laws are good, bad, just, whether justice is the right framework within which to think of them at all. But as it goes now, nearly every country is moving towards the panoptic synoptic model. I'd argue that there are more data sensitive models in some places. Jamaica is one, Uruguay is another. And we need to be in conversation with those sorts of people, right? The e-currency minute company that Rowan has worked with is helping build the thing in Jamaica because there's no public money R&D out there, right? And we've sort of in this problem where we need the money to make the money. But people are working on this, I think, with precisely this in mind. And crypto was supposed to be the savior of everybody, right? If you're a sex worker, you use Bitcoin or maybe use Cash App, but the idea is that you stay outside of the system. Crypto has become an attraction to law enforcement, right? Because if you make a lot of noise about hiding, they're going to come find you, right? The US government is going to come find you, right? So that's become its own thing. And what we really think we need is, what if you had the ability to just participate in the digital system and use cash and nobody had to know about your business? Are people going to use cash for bad things? Sure, just as they do now. But this idea that cash is dirty, that cash is something that an old tech that we should let go, an informal tech, is racialized, it is gendered, it is thought of in the context of imperialism in the United States is literally our paper dollars are out there, et cetera. But more importantly, the new financial technological systems. What happens in the technological upgrade of SWIFT, the communication system for international money, essentially, and credit, central bank swap lines, that it matters. So we've got low finance where it really matters and people are going to be oppressed. And then we also have high finance where they're building this watchtower. And then you get in conversations about what happens with sanctions in Ukraine or in Russia, what happens about all of this. And the international dimension, I think, is where it will really play out. Ro, do you want to say anything about your work with UN or anything?
Yeah, two quick things. One, Brett Scott, our friend who's been one of the biggest advocates of physical cash, really holding down the fort while sort of playing the rearguard action while we're trying to sort of play the vanguard action on this. He likens cash to a bicycle compared to a car. It's not that it's sort of new, we've had bicycles for a while, but it's really important. In fact, there are situations where even with new technology, we want to be moving a little bit more bicycle users. And then the other example he uses is if you're designing a high-rise building, you're building elevators, that's great, but you also put a fire stairs. Because of the elevator breaks, you want to make sure you can get out of the damn building. And so this is a matter of resiliency in design, it's a matter of that kind of concern for risk management and long-scale risk. And then the other thing on the UN side, we talked a lot there about neutral principles, getting a standard, getting a framework. And one of the challenges is the word privacy is weaponized cynically. Just like people talk about fiscal responsibility, it's entirely irresponsible how they're dealing with things, right? The idea of privacy, someone like Powell will say, yeah, of course I care about privacy. And then in the next breath, they'll say, but anonymity is possible, right? And there's that chill that goes down your spine because they're literally co-opting the language of freedom to build surveillance states. And we have to be really clear about that. So there is work at a sort of academic, theoretical level to build the framework, to build the terminology, to be able to distinguish between real and fake freedom on that front. So the only last thing I want to ask you maybe is the problem. I've been thinking a lot about building the cash with different technology, right? But people use credit cards and stuff because of the points.
Yeah.
And the monetary technology itself is against us in a sense. And I'm increasingly worried about that because we might build a really good, easy to use cash card and everyone will just keep taking points. So what do we do about the culture?
Yeah.
Of sort of surveil money being gamified as well? That's my kind of thing.
Yeah, that's a really important question. And I think, I don't know how to solve that in particular, but I do think that we can directly attack credit cards, for instance, on a political economy front, from other angles. For the retail side, for instance, like if you have e-cash, you don't need to use these credit card networks that charge fees to merchants, et cetera. So you can have a political alliance between small businesses and consumers in the United States, for least. But there does have to be a lot to sort of, I think what Rowan's suggesting, take the culture away from like money being gimmicked, et cetera. But a lot of good ideas are popping up around how to do that are beyond me, I imagine. Some of them come from the tech world themselves, from gaming, et cetera. And we have to think about this problem, I think, in more depth. Where I eventually want to go back to, though, is here. We're promoting a public fintech system, right? We're trying to build the damn thing. It's going to take many, many years. But, again, I believe, and this was discussed earlier, that MIT has a legal theory of money rather than a state theory of money. And there is room for other projects driven by communities, et cetera. Community currencies will never accomplish the functions of a fiat currency, but there is space for these things. And within that realm, I am particularly interested in it continuing because of the capacity to have what Foucault called an insurrection of subjugated knowledges, right? We've lost so much fintech because of imperialism. We've lost so many ideas about how we think about what money is. And so if we can get back there through this tech space and then look toward the future, I think that's actually an extremely rich approach. And more importantly, we have to offer, again, a vision of hope. We have to offer something that looks towards the future, that takes MMT into the future. Because right now, when crypto comes along, people like us who think like us, as well as, Democratic Party policymakers in labor parties around the world, et cetera, we're just saying no. No, like it's bad. Don't do that. No. We need to have a yes. And I think that MMT is particularly politically attuned and disposed to create that yes, right? To add to our vision of what public money is, this idea that money is a technology, but there are at the same time all these familiar problems that we need to bring in to the future, right? And so I hope with this presentation, you've at least seen something in here that interests you, that connects to whatever your angle is on MMT or the post-Keynesian tradition. We have a long way to go. It's very exciting, though. Of course, the world's going to bake, crypto's on the loose. But I like to think that with like-minded people, we can approach the future just as confidently as the people on the other side. Thank you.